Created with free version for non-commercial use.
Hello guys and girls, and welcome to season 2 of Quick Tips. I am so excited to get into the season as I believe it's going to provide so much value. Now, I wanted to take my time a little bit with this season as I wanted to just listen to the most common and popular questions that we get that I believe that is going to provide the most clarity and value. Now, within this season, we're going to be covering things like entry types, management, 90-day plan, pattern separation, all of the kind of things that I believe that is going to just take people's trading to that next level. And I really wanted to listen to what is going on in the community, so then it's relevant to really improve people and take their trading to where it needs to be. So with this particular episode, we're going to be focusing on entry types. So I'm going to provide a bit of clarity on reduced risks and some risk entries, and my personal style on how I take them. And when I don't take them, what is a higher probability setup and what is a slightly lower probability setup? So let's dig into that and keep it as simple as possible. So I want to begin with EuroCAD. So firstly, if we start off on the daily chart, let's take a look at the structure. When we look at this particular structure, it's important to understand that when you're building your structure, your higher time frame is very, very important. And when we're looking at a particular position like this, when we're taking a reduced risk or we're taking a risk entry, you need to know what phase you're in. And that's very, very important when we dig into the lower degree. So for example, taking a reduced risk flag in a corrective phase versus taking a reduced risk flag in an impulsive phase, the probability is different. One is higher. In the impulsive phase, the flags are going to be a higher probability. In a corrective phase, it's going to look very similar, but it's going to be less probability. And I think this is where some people could be caught out. They could be tagged in and tagged out and they don't really know what's going on. So I want to provide a bit of clarity on that. So let's take a look. We have our daily structure. Naturally, at the top of this trend line, of this pattern, of this structure, we're looking for selling opportunities. And then when we drop our lower degrees, we can see what's going on. So let's look at that. So if we go to the 4-hour chart, we can see this. Let's build the picture here. If we're looking at this pattern, we can see this is an ascending type formation. Naturally, we'll be looking for selling opportunities. Now, where would those selling opportunities potentially arise? Well, we'd be looking left and looking at the previous highs and marking those on and saying, well, there's a few possibilities. We can either actually break the trend line, make it to this high, and then still move to the downside. We can either get to the outer structure of the pattern and then sell off like this, or we can go a little bit earlier. And where would that be? It will likely be these highs here. So how do we deal with that on the 1-hour chart? Let's take a look. Well, when we go to the 1-hour chart and we're looking for let's say a reduced risk entry, when we're looking at that and we're building the picture, we can see that within this formation, we previously had this data. So let's actually take that back. We would have something like this. So when we're building the picture, we have this ascending channel. Naturally, when we're looking at a formation like this, we're looking at this structure. You can see we have multi-touch identification. 1, 2, 3. We've got those rejections. Naturally, we're looking for any kind of hover or any kind of rejection around here. As we know, this is one type of entry. We could get to the trend line here, or we could get to here before we drop. So knowing that, we're not just going to keep waiting for the perfect entry. We're going to enter if it's valid. So as we just speed up here, we start to create this hover type formation. This is normal. This is a normal valid setup that we would take. You can see that hover. We've got more than 6 to 8 hours of those corrections, a minimum of 6 there, so we can take that trade. And you would take it on the break like this. You'd have your entry below and your stop either above the high, which would be very unlikely within Falcon, and you'd have it about 30, 35, just above the top of that correction. So an easy, great tip to mark that on is to simply have just a point of reference that you can see, well, this is the high of the flag, this is the tight correction. I'm going to have my stop just above that. So 35, even 30 could be quite tight, but let's say 35, and with your target down here and so on. Now as that goes a little bit further, you can see you'd be tagged into the trade there. You can see that's a hover. What is the difference of why this is a lower probability compared to, let's say, one that was up here? Well, we have to firstly understand this part, looking left. This is the high. The mass psychology suggests that when we break the high, we're getting people caught on the wrong side of the market to then drop. So this setup, this didn't break that high. So already in my mind, I'm looking at, yes, this is a 1, 2, 3 touch pattern, but we have this hover here that this could drop to the downside. It's not about not taking that trade. It's understanding where we didn't break the high. So it's very possible already for this to trickle out and move a little bit higher to break this high before it drops. So let's see how that plays out. You can see it trickles its way through, still part of the flag. You'd still stay in the trade, and then it drops to around here. This is where you move it to break even, of course, as we get the retrace. Now, this is one of those trades in which that you entered that you may not have taken a break even on it. You may have taken, a tiny little loss with those kind of momentum. So when you get that momentum, sometimes you get a little bit of slippage. So either a break even or the tiniest loss. But just leaving your stop open, hoping that it's going to play out, this is where it creates that anxiety. And this is normally just old beliefs that you've developed from somewhere else. So you need to realize that sometimes it takes a bit of time to unlearn and just remove those old habits and replace them with good ones. So when looking at this, you can see that type of structure and the nature that it's possible that this can trickle out and move higher. Why? Because we're going back to the same psychology that it didn't break that high. And when you're taking a hover like this, a reduced risk entry, you need to have that in your mind. You can't look at that in isolation and say that this is exactly the same as a different setup which we're going to cover. You need to realize why you're taking it, and it always starts with the mass psychology and the higher time frame structure. So as this one continues, we can speed that up. We break above. Now this is where it gets interesting, where it's really going to provide a lot of clarity. We can look at evolving this pattern now. Why is that? Because we've had no progression, and we've now moved to the upside, and this actually created more of a continuation to the upside. So we would evolve that structure and say, well, this is now the pattern. What would be the next point of reference that makes sense for this trade to go to the downside? Well, we can look left again and say, well, this is the mass psychology. We can look at this left and say we've broken the high, we've got a rejection within that area. As we speed that up, this could be a point in which that we could get involved in the market. Now, these are the type of points in which that you have to look at it this way. You've got the left here. You're so close to this outer structure. If I just get it right to the wick there, you're so close to the outer structure. If you're going to take that trade, it needs to be above there or above the pattern. So in this type of situation, you can either look to take those trades on the break of this low here like this, on the break like that, which this would be one that you would probably not get entered in, or you'd have to have a stop for about 50 to 60 pips. In that type of situation, it's good to be patient and wait. Whenever I see something that's like a 60, 70 pip stop, through back testing and through experience, I'm always keen to just take a step back and say, right, do I really need to force the position with a 60, 70 or 80 pip stop, or do I just wait? Because there's so many opportunities. It goes back to just understanding the possibilities. So as we move on, you can see we break above and then we start to create that kind of risk entry style formation. This is where it gets interesting. Whether you took that risk entry here or not, as you can see, slight involvement there, that makes sense. The next point is either this trend line or this high here. Now we know that it could go there, but now we've got our first impulse to the downside. It's more about that hover here. Let's move a little bit more. So you see this flag, we get that continuation. You can see the flag here, 6 to 8 hours as this trickles and then it breaks. Is that flag the same as taking a flag here with the hover here? No. Reason being, this flag had already broken this high. So we'd already broken above this high and impulse back down, created the flag for the sell. This one here was within the pattern, but it hadn't broken that high. But they look similar, they look like flags. Now let's take it a little bit further. So when we see this kind of formation, this flag here, this looks almost similar, more so to this pattern here. See that flag? And I think what is happening sometimes is some of you guys and girls, more so new guys and girls, you're seeing these kind of patterns and thinking, well, that looks very similar to that, almost identical. So what makes the difference? Should I take that trade or should I take that trade? Again, it goes back to, there's nothing actually wrong with taking that trade, because if you took this trade and it dropped down here and made you 7%, you would say, oh, it's a great trade. It's more so if you take that trade, you need to be prepared of what these can evolve into because it didn't break that high. That is the key message. So you need to ask yourself when you're taking these reduced risk entries or even risk entries, what am I surrounded by? Is the market at the top of a pattern? Is it actually broken the high yet? What could it evolve into? And what is it likely to do? Because we know that the market generally kind of gets people caught on the wrong side, breaks previous highs, and then it drops. And it gives us a pattern to showcase that. So when we're looking at those two trades, we can say, well, this flag looks the same. This is a much higher probability setup than this setup, because this has broken the high, it's impulsed, and now this is its first impulse. So it's now confirmed the break of the pattern impulsively, and this is the continuation to continue to then drop. So you see the difference there. That is how the market really works. You need to understand the mass psychology so you know what is actually going on and realize the difference. So when you're taking trades like this, it's really not about, well, you know what, I was tagged into that trade and tagged out. It's more so, if you're taking that trade, are you looking left and are you managed accordingly? So for example, if I was going to take a trade like this, and there's nothing wrong with taking the trade, I could still take this type of trade, but then I knew, let's say I wasn't going to be by the screen for 3-4 hours. I was going to go into a property meeting, for example, and I knew I wasn't going to be by the screen because it hadn't broken the previous high. I know this type of pattern could easily evolve, move higher, and then drop. So then I would make the decision that, right, within my trading plan, if I'm not going to be by the screen, I'm not going to be able to manage it effectively the way I want to, I'm not going to take the trade. And then I accept fully if that trade impulsively goes, and let's say I come out the meeting and I say, right, oh, that trade's gone, I didn't take that trade. I don't sit there and beat myself up about it. I then go back to, I understand that, right, well, this is confirmed now, and what I'm actually going to wait for is a continuation and take a reduced risk like this, but take it here. So it goes back to, what is your mind saying? What kind of mind games are you playing with yourself? Are you saying to yourself that if I don't take that trade, there's not going to be any other positions, so I want to force it because I have the fear of missing out? Or do you actually understand how much opportunity we really have? And then you can say, right, that's not really in my plan. That's, you know, it's a quite good setup. It's an average sort of setup where these setups, risk entry, reduced risk, where they've actually confirmed, those are the high probability setups. So you literally need to keep it as simple as that, and understand that just because it looks similar to this doesn't mean it's the same thing. It goes back to looking left again. So I hope that's given you a bit of clarity from the higher time frame structure and drilling down and really understanding why we're taking these trades and when to take them. So you can see that in the corrective phase on that previous entry with that hover, that's in the corrective phase. So a reduced risk entry in the corrective phase versus a reduced risk entry on the impulsive phase like this is completely different. This is a far higher probability setup compared to this setup, but even though they look identical. So that's how you need to see it. It's building the phase, understanding what phase you're in, and then acting accordingly with your trading plan. So remember, don't be too hard on yourself, but just focus on, sometimes you are going to be tagged into trades, tagged out, but it's more so, these are the high probability setups. Include those in your plan, screenshot them, and build that plan over time. Remember, to be successful in this game, you need to take losses to build the thick skin, and then your plan will become better and better, and you'll have your go-to setups like these. Very clean, very simple trades. So that's reduce risk. Now I just want to get into a couple of risk entries to provide some clarity on that as well. So let's dig into that. So now let's take a look at some risk entry positions. So I want to start off with dollar yen. So with dollar yen, let's take a look. So there are a few previous trades within this structure, and I want to start off with the trade at the top. This is actually a recent position that I took for a break even, and I want to explain it. Well, if we look at the high time frame structure, we're on the daily chart. Even if it was on the weekly, it's the same kind of thing, because we can see we're only looking at this previous high here. But the high time frame structure suggests that this is an ascending channel, and as we break the high, are we potentially getting people on the wrong side of the market to correct back or impulsively move back to this trend line here? It's very much a possibility. So when we go to the lower degree, and we go to the 1 hour chart, we're looking at this. We've now broken the high. And if we take this back and we look at it here, this is a recent trade. So when we're looking at it, this is the top of the structure, this is the top of the pattern, and we can see that we've got this angle, this trend line here. This makes sense now as it touches the wick. Now, as it touches the wick there, we're looking at a risk entry within that area. That's a natural, typical entry within Falcon. We know that after we get this tiny little flag, we could just get a little move up and just trickle its way up before we get the drop. So it's very much a possibility. Now, the question that I get is, should I take the trade off of that rejection there? The real answer, it goes to stop size. A lot of people that have these fixed type of stop sizes where they, I have to have a trade and it has to be 25 pips. That's the wrong way of looking at it. It's more about what does the market present to you. Now, naturally, I don't really take trades anything over, 55 to 60 pip stops because I know that I can get into another entry tighter and achieve a high risk to reward. But it doesn't mean that I sit there and think, right, I have to get involved in a 30 pip stop. That's not how the mind works. So when we're looking like something like this, it's not the fact that this has got a wick, it's the area. So for example, everybody has different time zones. One person could be waking up to this entry, some person could be going to sleep. So for example, if you're going to take this entry, you're taking that rejection in the anticipation that, well, if I'm going to go to sleep, I need a slightly wider stop because this could trickle its way up like this and then still drop. So you're not going to have a stop like this for the sake of it to be super tight because your risk to reward is higher. Because remember, look at the bigger picture. The bigger picture is that we're going to take this trade to the downside here, where you're looking at it and saying, well, if I have a 23, 25 pip stop, I've got a 10% risk to reward. And if I have, let's say, a 30 pip stop, it's only 7.7. This is where the greed kicks in. The whole goal at the beginning to get consistent, you don't get consistent by hitting 20% months. That's not how consistency works. You don't just become the good trader and then hit 20% a month. That's not how it happens. What happens is you consistently build. So for example, what's more important at your beginning stages is actually hitting things like 6% a month, 7% a month, 8% a month, and building. It's more important for your mind for you to be in these trades with a slightly wider stop, experience being in the trades, letting them play out, managing them, banking the return. You might start banking, 4 or 5% per month, and you build on it. And then you can refine and know when to have a slightly tighter stop loss and when to not do that. So that is the goal. Don't have this fixed stop loss size that you have in your mind that you think that the market has to respond to. It's like making it perfect when the market is imperfect. And when we're looking at it here, what I personally do is I'm looking for a rejection around that area that is dependent on what I'm doing in that situation. So this is where the discretion has to come in, because different time zones, like I said, someone might be going to sleep, someone might be waking up. What do those two people do in that decision? It's more a matter of whether you can wait, be patient with the comfort that even if this trade from here dropped, you wait for the next continuation and you'll still be able to capitalize and keep going. What happens is people force these trades because in their subconscious, they haven't truly worked out or back tested or believe yet that there's more opportunity. That's where the fear of missing comes out. That's where it creeps in, because you haven't truly seen yet, or your subconscious hasn't wired that in, that there is more opportunity than you realize. So naturally what you do is you force positions. So as we trickle up like this, anywhere within that area. So at this stage, you can see now we've trickled up, we've got that low momentum corrective style nature, and we have this type of formation. Now this could trickle its way down like this and trickle up a little bit. So naturally you need to use your initiative and realize if you're going to take a trade like this, even getting in around this area, your stop has to be just slightly wider, and you need to be comfortable with, let's say, a 30 pip or a 35. And when you get to this area here, got a couple of percent, 2 to 1, but the real target is at this stage here, so 6.6. What someone's doing is they're seeing that, well, this could be a 10% position instead of 6.5. The greed kicks in, and then those people end up not being consistent as a side effect. And someone who is slightly more conservative will take the trade, bank it, might make 6 to 7% per month, but then they can refine these stops as they get better and better. That's how you become consistent and get those bigger returns. It's not, the one-hit wonder. That's not how it works. So when taking these trades, I'm not counting 1, 2, 3, 4. Let's put the trade on. It's been 4 hours now. It's more the area. It's a risk entry for a reason, because it's at the top of a pattern. So it's more the fact that I'm looking left and saying, well, we've broken the high now, mass psychology. It's a risk entry at the top of the pattern. I'm happy to have my stop above the pattern and for that to play out. As we trickle on, you can see it moves to the downside. I'm very well prepared that this can just trickle on and do this and take me for a break. That will take me for a break even, and then I'll take that trade again. So it's about forecasting and planning ahead as it trickles on. You can see that move up like this. And now we have this type of structure. So seeing that type of structure, it's more a matter of, if you're going to take a risk entry, you can't half-heart it. So for example, what people tend to do is they see a risk entry like this, and rather than, let's say, taking this trade after this rejection here, let's play that. After taking that trade there like this, their mind says, well, you know, I want this to be a little bit more confirmed. So what I'll do in this type of situation, I will set my entry a little bit lower to here. I'll set it here. So they're kind of in no man's land. They're not really going where they need to be. They're setting trades like this. They think that it's safer doing it that way. But that's just going in half-hearted. If you're going to go in for a risk entry at the top, then you back yourself from what you've back tested and what you know to be true, and then you take the trade. And rather than just choking it here just because you want that higher risk to reward, at the beginning stage, that's not important. That's where you fine tune after. So you'll be looking at something like this for about a 30 pip. And then you're not going to have that anxiety of, you know, being tagged in, tagged out very quickly. You're going to take a step back and say, right, that makes sense. I can take that trade. Any corrective candles around that area, it's perfect. So you could have essentially taken that trade after this rejection here, a slightly wider stop. This rejection, this type of rejection, anywhere around there would be absolutely fine because it's a risk entry. And with a risk entry, nothing is yet confirmed. You're taking it on the anticipation that this will reject off the pattern to the downside. Remember that. As it trickles its way through, you'll be tagged in like this, like myself. And as it moves to the downside, then taking a break even, and it just trickles its way up. But again, this is expected. We know this could potentially happen and develop into a deeper version of itself. So I think with the risk entry, what you need to be doing as a trader, especially if you're new, is really understanding, what do I need to see? And it's not, you know, 10 different things that you need to see. It's as simple as, if it's at the top of the pattern within that area, as long as it's corrective, any ascending channel that you have within that area as well, any low momentum candles, is absolutely fine. And when looking at something like this right now, you'd be looking at that type of trade and saying, well, if this trickles up a little bit further, it's very, very close to that area. If we get a complete retrace of a candle there, then you can then take that trade to the downside. Or if it trickles up like this, you'll then be looking to take the trade on the break of the trend line with your stop above here again. The goal is not to get the stop here like this, 13 pip stop, just to get it tight, because you'll be tagged in and tagged out very quickly. Remember, the goal is for you to experience being in these trades. So rather than having that fixed stop size, take a step back and realize, gain experience in the market first before you do that. You can fine tune that after. At this stage, you need to learn how to be involved in the markets. So just a bit of clarity there on how to take these risk entry positions. And I just want to cast your mind back to how this one is actually a slightly higher probability to the one down here. So if we take a look back just a little bit more and look at this previous type of setup. Now, when we're looking at this structure, if you imagine just removing this data, I think this is going to help a lot. When you're going to remove this data here, when taking these style of trades, let's say, for example, you're looking at this here. What would you have previously? You'd have this high, this break here, and this previous high here. So naturally, you'll be looking at this structure as, well, we've broken the high, we've broken this high here, we've broken that high, we've now got an ascending channel. So is this getting people caught on the wrong side of the market? What kind of pattern will we have? Well, let's actually delete this and then showcase that. So you'd be looking at this type of structure like this. Let's draw that on. You'd be looking at this type of structure. And when you're looking at that structure, you're going, right, 1, 2, 3, essentially. This is broken the high. I'm looking for a rejection within that area. At what point can you take that as a risk entry? Well, you're going to look for some kind of retrace, some kind of rejection. So at this stage, you can say this: when would it be too early? Well, notice how we get this rejection here, this rejection here. It's very, very close to that area. So you really want a rejection off of this little arcing double top. So essentially, could you put a trade on here like this. You can, but you normally need some kind of rejection that moves off of it first to solidify that that's the trend line. So you can see here that when you're taking this kind of trade, after that rejection, that retrace there, can you take that type of setup? You can, but you need to be prepared for this. You'd be taking the trade like this to be tagged in, and you could potentially be tagged out. And I think what some people are doing is this. You're taking the trade after that retrace, it goes back to this tight stop loss. You've already got the angle with this. 1, 2, this is the pattern here. So you've already got that angle formation there. And essentially you could even adjust that after you get this move to the downside. And then you would move this trend line like this just to get the truest form. You can see that 1, 2, 3 lines up with that pattern. If you're going to take the trade, you need to have it above like this because you're going to be tagged in, tagged out, and this could be one that does that. So to wait for more confirmation in these type of areas that isn't really that great of a setup, you need to realize it's just, when we zoom out, it's only within this type of area here. It's just an average setup. It's not at the real top of a clear pattern. It's just an average setup. And I think that's what we need to realize, the difference between taking a trade here and then taking a trade here of some previous highs where they break the structure with a particular pattern, or just one that's just in kind of in no man's land. And when you're taking these trades, these are the kind of ones you don't really need to have within your plan. They're just average setups that just get you tagged in and tagged out, and they're not really solid multi-touch identification ones that have a clear pattern and clear plan. So when taking these kind of trades, I think the best thing to do is to remove them for your plan without solid confirmation. So when looking at it, you need a valid trend line. So you see the same way when I talk about particular flags, you're looking at this. You're looking for an impulse, and when you're looking for this correction, you want the second touch before you can decide that's a flag. So you want it to move off for that second time. So you can say, right, this is the bottom of the flag. There's that second point, it's moved off. And then when it comes down, that's essentially the break of the flag now to go. So that would be the break of the flag because you have that second point. The first point, the second point. The same with one of these ascending channels. You need to have a trend line where it's actually moved off of it for the second point to move off. So then you can, at least you can go back and say this. You can go back and go, well, at this point, now you've moved off. 1, 2, you can see that trend line there. That makes sense. You can see the rejection. What you're waiting for is a complete retrace as a confirmation to say, right, this is actually an entry now. And as we trickle down, you can say, is it this one here? Just click by click. That is a rejection. So essentially you can have it's a hanging man type formation. So you can have it below the trend line and just have it above the high like this. Again, it's not about having the tight stop loss. Give it a slight bit of room to breathe. And then you can just tick by tick. Then the retrace, of course, that is the most solid retrace, as you can see that there. So you'd move your stop, you'd move your entry up just a little bit. Now you can see we have some solid rejections. We have 1, 2, and it's just about to break on the third one. Now that makes sense. That's a higher quality of setup. And I think what you guys and girls need to do with your trading plans, you need to have this specific, so you understand that you're not just looking at that retrace there and saying, right, I want to put that trade on, and you'll need to almost want to get into the market. You then just get into the trade for the sake of it, and then guess what? You're tagged in, you're tagged out, and you think, oh, was that a good trade? Was that an average trade? And I can see why that happens. So I wanted to shed a bit of light on the difference there. So again, that probably would have been a break-even trade, but notice how that it just trickles its way there. You can see that if we just stop that for a second, notice how it's more about how does the market respond. See how it just moves in the form of a descending type formation. So this is no surprise that this moves up, and it's just part of a bigger channel like this to potentially correct back to the trend line and then climb to the upside. So it's just about understanding the difference there. And then when we look at these styles of entries, reduce risk and risk entry, it is very simple. It's just looking out for these tiny little tweaks. And sometimes these 1% tweaks make such a big difference within your trading results overall. And if we take a look at this particular area up here, we do get what I call a lot is the retrace candle. This is something I use a lot with my management and my entries, more so management and entries than previously before, but I am starting to use it more for entries as well. But management is absolutely key. And it brings me on to the next episode. So entry types is good within itself with risk entries and reduced risk, of literally looking at those areas and not having the tightest stop losses and understanding the difference, like on EuroCAD, between the phases. So a reduced risk flag in the impulsive phase versus the corrective phase have a different level of probability. The one in the impulsive phase is a higher probability. Now, when we're looking for the retrace candle, it's exactly the same thing. And I'm going to dig into that in the next episode, as I believe that's going to provide a lot of clarity on both management and entry point. So I hope you've enjoyed that, guys and girls, for this quick tip that's slightly longer, but I wanted to go into a bit more detail, as I believe it's going to help a lot of questions that I get. So let's dig into episode 2, where I dive deeper into that retrace candle that's just going to further your entry types, why and when we do it. So let's get into that.
Created with free version for non-commercial use.